John Crypto here. Here's the headline they don't want you to sit with for more than 2 seconds. $2 trillion erased from crypto in under 72 hours. Not lost, not corrected, erased, vaporized, bled out of the system. Bitcoin, the so-called digital gold, gets nuked from its recent highs and is now hovering around $67,000, looking stable on the surface, while underneath the market is still hemorrhaging. The total crypto market cap down almost 50% from peak cycle levels. Now here's where it stops being normal and starts smelling like a setup. While price is collapsing, 24H volume, 165.9 B, 8.9%. Open interest, 95.6 B, plus 2.86%. Liquidations, 216 mem, 45%. Read that again slowly. Price goes down. Fear is everywhere. Headlines screaming, crash. And yet, open interest goes up. That's your first red flag. Because in a real panic, open interest doesn't rise. It dies. People close positions. They run. They de-risk. But this time, someone is adding exposure while everyone else is being forced out. Here's the kicker. This wasn't a market collapse. This was a liquidity harvest. Now connect the dots with what the media is feeding you. They're pushing 3 lines on loop. China banned crypto again. Retail panic selling. Risk-off environment. They want you to believe this was organic, emotional, random, just a bunch of scared people smashing the sell button at the same time, coincidentally across every major exchange, in perfect synchronization, wiping out billions in leveraged positions within hours. Yeah, sure, this is the same script they ran in 2020, the same script in 2022, the same script every time wealth transfers hands. Blame the crowd. Hide the operators. Because the truth is uglier. This was a forced liquidation event. Over $216 million in longs wiped out in 24 hours. Not investors, speculators, retail traders. The exit liquidity. Long-short ratio, 50.07%, 49.93%. That's not a market. That's a slaughterhouse with perfect balance. That ratio means the system was primed. Every stop loss was mapped, every liquidation level known in advance. Retail thought, support is strong, I'll leverage 10x. Smart money thought, perfect, now we know exactly where to strike. So they hit the sell walls, triggered cascades, forced margin calls, and watched as positions evaporated in milliseconds. This wasn't fear, this was engineering. Here's where it gets criminal. If this was real panic, genuine mass exit, then open interest should have collapsed. Instead, it climbed to $95.6 billion. That means new contracts were being opened while price was falling. Translation: someone was buying the crash with size, not spot, not visible on chain, through derivatives, futures, perps, silent accumulation while you were busy being liquidated. This is the oldest trick in the financial playbook. Distribution, crash, accumulation. They distribute near the top. They crash the price. They accumulate what you're forced to sell, and then they rewrite the narrative 6 months later. Institutions are bullish again. Now look at the bodies on the floor. Bitcoin, over 5,700 BTC liquidation events. Ethereum, more than 3,900 traders wiped out. Solana, XRP, Doge, all the usual retail favorites lined up and executed one by one. People didn't sell. They were removed from the market, their positions closed by algorithms, their collateral absorbed by exchanges, their coins transferred to whoever had enough capital to stay solvent through the bloodbath. And while you were watching your account bleed red, smart money was doing the opposite, loading futures, rebuilding leverage, buying synthetic exposure at a discount, not because they believe in Bitcoin, but because they understand the system better than you ever will. They don't trade charts, they trade human behavior. Fear is their asset, panic is their profit, your liquidation is their entry, and this is the part that should make your stomach drop, because if people were truly selling Bitcoin in mass, if this was real capitulation, price would be collapsing with open interest falling off a cliff. Instead, price drops and open interest rises. That only happens when retail is forced out and institutions step in. It's a transfer, a swap, a quiet handoff of ownership from weak hands to strong ones. They call it volatility. I call it financial predation. So ask yourself the real question. If this was just fear, if this was just another China ban, if this was just emotional selling, then why is $95 billion still locked in leveraged positions? Why is someone still willing to risk that much capital while you're being told to stay cautious? Because the crash wasn't the event. The crash was the cover. The real action happened behind the scenes, in derivatives, in liquidation engines, in the invisible layer where price is manufactured, not discovered. And that's why this story isn't over, not even close, because you've been staring at the chart, while the real crime happened somewhere else entirely. On exchanges, in wallets, in supply. You think this was just fear. Wait until you see what's happening to Bitcoin supply on exchanges, because that's where the real crime happened. But if you think that liquidation flush was bad, wait until you realize there isn't even enough Bitcoin left on exchanges to support the paper market that's trading it. Here's the real crime scene. Bitcoin circulating supply is 19.98 million coins. Max supply, 21 million. That means more than 95% of all Bitcoin that will ever exist is already mined. Now layer this on top. Institutional treasury holdings sit around 1.17 million BTC. That's MicroStrategy type entities, funds, corporate treasuries, sovereign proxies, coins that are not coming back to market. And yet exchange balances are sitting at multi-year lows. More BTC is leaving exchanges every single day than entering. Not trading desks, not whales. Regular users pulling coins into cold storage. Translation: people are not selling. They're disappearing. They're taking their coins off the casino floor and locking them in vaults, which means the visible supply, the BTC that can actually be bought or sold at market, is shrinking while demand is exploding. And that's where the system breaks. Because what's being traded right now isn't Bitcoin, it's paper Bitcoin, futures, perpetual contracts, options, synthetic exposure, claims on Bitcoin, not the real thing. Here's the imbalance that should terrify you. Over $95 billion in paper BTC claims versus only $42 billion in real spot volume. That's more than 2x leverage baked into the entire system, meaning for every real Bitcoin, there are multiple people who think they own it. This is fractional reserve Bitcoin. The exact same scam as fractional reserve banking, just with better marketing and a blockchain UI. You don't own Bitcoin, you own a promise. And promises collapse when everyone asks for delivery at the same time. Now ask the most important question. Who benefits from this structure? Because someone designed it this way. Exchanges love crashes. Every liquidation pays them fees. Every forced close enriches the house. Market makers love crashes. They front-run order books, trigger cascades, and arbitrage the panic. ETF custodians love crashes. They get cheap inflows, long-term custody, and total control over real supply. Banks love crashes because it lets them accumulate at levels retail will never see again. This is why every major dump looks the same. Price gets smashed. Liquidations explode. Headlines scream crypto is dead. Then weeks later, institutional inflows hit record highs. Same movie. Every cycle. Crash the price. Force liquidations. Scoops cheap BTC. Then announce confidence is returning. They don't buy strength. They manufacture weakness. And they've done this before. Housing market. They told people homes were safe. Then pulled the credit. Triggered defaults. Bought foreclosed properties for pennies. COVID crash. They shut down economies. Markets collapsed. Retail sold everything in fear. Central banks printed trillions and bought the dip. FTX. They let the largest fraud in crypto run unchecked, then used the collapse as justification for regulation and consolidation. Exchanges died. Market share moved to the biggest players. Every time the pattern is identical. Retail gets wiped. Institutions double wealth. Not because they're smarter, because they control the rules of the game. And here's the part nobody wants to say out loud. There is not enough real Bitcoin left on exchanges to support the current derivatives market. If even 10% of paper holders demanded physical BTC delivery, the system would snap, exchanges would freeze withdrawals, prices would disconnect from reality, and suddenly everyone would realize they were trading IOUs, not assets, which is why the real battle right now isn't price, it's supply. Who controls the real coins? Who holds the keys? Who can actually withdraw when things break? Because Bitcoin was created to escape this exact system, and now the system has rebuilt itself on top of Bitcoin. Same leverage, same paper games, same predators, just new logos. So when you see crashes like this, understand what's actually happening. It's not fear, it's inventory management. They are emptying exchanges, flushing weak hands, transferring supply into long-term cold storage, while telling you the market is risky. They want you in cash. They want you in fear. They want you watching candles while they quietly lock up the remaining real coins. Because once the supply is gone, price becomes irrelevant. They don't need your participation anymore. And that's why this story is about to turn geopolitical. Because the next phase isn't about retail versus institutions, it's about nations versus nations, and that's where this stops being a financial market and starts becoming a currency war. But here's where it gets insane. While the West is panicking, the East is buying everything. While the West is panicking, the East is buying everything. That's not a metaphor. That's not hype. That's what the flows are screaming if you stop staring at headlines and start following the money. In the West, all you see is fear. People refreshing charts, watching red candles, waiting for confirmation, asking analysts on TV if it's safe to enter. They're selling emotion. But in the East, Hong Kong funds are accumulating quietly. OTC desks in Asia are absorbing supply without touching public order books. Cold wallets are growing, not shrinking. No noise, no headlines, no social media victory laps. Just silent, methodical accumulation. And that China ban everyone is screaming about. It's a smokescreen. China didn't ban Bitcoin. China banned you from accessing it. They restricted retail, not institutions. They cut off speculation, not accumulation. Because the last thing a state wants is millions of citizens front-running a strategic asset before the government finishes positioning. So they lock the door while buying through the back entrance. Now, connect the next dot. On-chain data is showing massive unknown wallets accumulating Bitcoin. Not exchange wallets, not whale traders, not retail clusters. These wallets never touch centralized exchanges, never panic sell, never rebalance. They only do one thing: accumulate, slowly, relentlessly, permanently. No profit taking, no leverage, no stop losses, just raw capital converting into hard supply. And the size? Too big for individuals, too disciplined for traders, too patient for funds. This smells like sovereign money, state-backed entities, central banks using proxies, the same playbook used for gold. You don't announce, you don't advertise, you buy quietly until the price escapes. Here's the uncomfortable truth. This isn't a market anymore, it's a geopolitical asset race. China restricts retail, the US approves ETFs, Europe tightens regulations, Asia builds OTC infrastructure, each side pretending to protect investors while actually controlling who gets access to real supply. Because this isn't about crypto adoption. This is about reserve dominance. Who controls the asset that replaces the dollar? US treasuries, debt-based money. Bitcoin isn't competing with tech stocks, it's competing with sovereign power. And the supply side makes this even darker. Bitcoin mining isn't getting easier. Block rewards are halving. Difficulty keeps rising. Energy costs are exploding globally. That means less new Bitcoin enters the system. It costs more to produce every coin. Miners are forced to hold or shut down. At the same time, demand from institutions is increasing. Demand from sovereign entities is increasing. Demand from long-term holders is increasing. So you get the most dangerous equation in finance: shrinking supply plus growing demand. Uncontrollable repricing. No central bank can print Bitcoin. No government can dilute it. No policy can create more. The math is fixed. And fixed math is a nightmare for systems built on infinite debt. This is why governments are acting weird, why regulation feels contradictory, why headlines feel staged, why the narrative keeps flipping. One day, Bitcoin is dangerous. Next day, Bitcoin ETFs approved. Next day, retail banned. Next day, institutional custody encouraged. They're not confused. They're segmenting access. Retail gets volatility. Institutions get infrastructure. States get quiet accumulation. And once the supply is locked, price doesn't need marketing. It revalues itself violently. So when you see Asia buying dips while the West debates if Bitcoin is dead, understand what's happening. This is the same thing that happened with gold after Bretton Woods, oil after the petrodollar, US Treasuries after WYS2. Assets move from open markets into strategic reserves. By the time the public realizes, the price is already gone. And this time, the asset isn't metal or energy. It's sovereign money without a sovereign, which is why this story doesn't end with price targets. It ends with system failure, because you cannot run a global economy on infinite debt, finite assets, and rising interest rates. Something has to break, and this leads to one unavoidable conclusion. The global financial system cannot survive without a reset, and that reset isn't coming in the future. It already happened. You're just living inside the aftershock, because the numbers don't lie anymore. They scream. The United States is sitting on over $40 trillion in debt, not projected, not hypothetical, real existing obligations. Japan, their bond market is cracking under its own weight, yields spiking, central bank trapped, pensions quietly bleeding, global debt over $320 trillion. That's more than 3 times the size of the entire world economy. And here's the part that should terrify you. The interest payments alone now exceed the military budgets of most nations, meaning countries are no longer paying down debt. They're borrowing money just to service old money. That's not an economy. That's a Ponzi scheme with flags and national anthems. Now connect the next dot. Central banks are trapped. The Federal Reserve has exactly 2 options. Option 1, raise interest rates. That collapses housing, stocks, bonds, governments, banks. The entire financial system implodes under its own leverage. Option 2, print money. That collapses purchasing power, savings, wages, middle class, the currency itself. And they will always choose printing, because inflation is invisible theft. System collapse is visible failure. Politicians can survive inflation. They cannot survive riots. So they print, they dilute, they sacrifice your future to extend their present. And while this is happening, the real trap is already set. Banks do not hold your money. They hold promises. Fractional reserve means they keep a small percentage. They lend the rest. Your deposit exists mostly as numbers on a screen. When stress hits, withdrawals get limited. Accounts get frozen. Bail-ins replace bailouts. That's not conspiracy. That's written into banking law. Your money is legally theirs. You are an unsecured creditor, meaning in a crisis, you stand in line behind the bank, the government, the system itself. You get what's left, if anything is left. This is why Bitcoin exists, not as an investment, as an escape hatch, because it's the only financial asset in human history that has fixed supply, has no central authority, can be self-custodied, cannot be inflated, cannot be censored. It doesn't care about interest rates. It doesn't care about elections. It doesn't care about policy. It runs on math, and math doesn't negotiate. So let's talk about where this goes, not price, structure. Supply is draining from exchanges. Institutions are accumulating. Sovereign entities are positioning. Fiat currencies are decaying. That combination only resolves one way. The next cycle doesn't need hype. It needs repricing. Based on current data, BTC between $150,000 and $250,000 is mathematically reasonable, not optimistic, not moon talk, just supply versus demand. And longer term, 500,000 plus isn't crazy, it's conservative if even a fraction of global capital flees debt-based systems, not because Bitcoin is special, because fiat is finished. You cannot print your way out of infinite debt. You cannot borrow your way into solvency. You cannot maintain an empire on negative real rates forever. The system is already dead. You're just watching the slow motion collapse. So the final message isn't about charts, it's about survival, not financial returns, financial sovereignty, because when this system finally breaks, and it will, the only thing that survives is what you control. Not what you're promised, not what's insured, not what's guaranteed. Only what you hold, only what you custody, only what no one can freeze, dilute, or confiscate. Get out of banks, self-custody your assets, because when this system collapses, the only thing that survives is what you control. If this opened your eyes even a little, you're already ahead of 99% of people. The rest will understand this after it's too late. So do 3 things right now. Hit subscribe, because what's coming next will make this look small. Hit like, so this reaches people before the system does. And share this, because someone you know is still trusting banks. This isn't entertainment. This is a warning.